In this episode, we're talking about the hidden messages in the market from everywhere, and we're talking about how that's feeding into the market. There's minutia building again that could be creating a new market paradigm. There's momentum up, but there's also momentum down potentially. There's lots to get into. The hedge fund watch is normal, who's winning and losing, and we've got a new section called the pump perspective. So hope you enjoy. Okay, so heating up a bit, right?
Yeah, feels like the market's warming up. Mita, you had some stats on Brent.
We've broken out of the range on Brent. We've been talking a lot about the narrowness of the range. Something's definitely changed, right? I think there's a lot to unpack, but maybe not volatility, but certainly outside of this kind of band that was, people would seem to be mean reverting around. Yeah, and just generally, but I guess let's look at the stats to back that up. So starting with volume, Mita, what's the deal?
Sure. So just looking at my chart over here, average daily traded volumes for the week ending 6th of June have increased across different futures contracts and by tenor as well. So looking at aggregate volumes across all tenors and contracts in the futures and swaps contract, we have an increase of 18.6% week on week, which is significant. Although this is still down 8%, around 8.1% year on year. Nonetheless, I mean, considering the relatively risk-off period we've had over the past couple of months, this is the 18.6% is in itself really significant.
Yeah, we've been in a very low volatility band, not really, headline fatigue, and then suddenly for volumes to pick up 14% overall is quite a big deal. So if we marry that with open interest, has the risk been picking up as well?
So open interest has been picking up. I will caveat that this is T-2, although that last spike over there is...
Wait, this is Brent or...?
This is Brent, yes.
Okay,
this is
fine.
just Brent. So this is just for the August specific contract in Brent futures. And that last bar shows, the last bar is for the 6th of June. And that is pretty indicative of the fact that open interest has been rising alongside this rally that we're seeing over the past, since 5th and 6th June, which is significant because that displays the risk being put on.
Yeah. Okay. So unpacking this then, well, I guess we'll prove it with the hedge fund stuff, for example, but we know the CTAs have been short for a long time. So if they're getting less short as the market has been rallying, as Brent futures has been rallying, but then open interest is increasing, then the CTAs buying back would be open interest decreasing, right? So it's quite indicative of new speculative money coming in. Like, I don't think consumer hedging, we've seen any evidence of that. So it's basically speculative money coming back in, probably from the financial side, which would make sense with the kind of macro environment kind of improving and the equity market kind of on a bit of a run again, gold on a run, that kind of stuff, like risk on.
Yeah, and like dollars dollar's got such a weak narrative to it as well, and that often sort of spurs like prices up.
Yeah, and then people just generally seem risk on. I mean, this is like incremental week on week, but just because we were in kind of a sluggish period, it does seem to be like we're coming out of it. So what does that say about the volatility? I mean, the volatility should be coming out of its range as well, I would have thought.
So volatility is definitely interesting because, again, if you look at my chart here, so that yellow line, that orange line that you see is historical volatility over the past 30 days. So that is a measure of price volatility looking back. That is still coming down. And just going to this chart over here, this is just to look at options. So the reason why I look at options is to look at implied volatility, which for our listeners is future volatility determined by
Well, it's what the
options
market's
prices.
saying volatility is.
Exactly, yes.
The standard deviation of the actual prompt, yeah.
Exactly. So just looking at this measure of volatility, it is slowly drifting downwards still.
Yeah.
I was talking to our option trader and he mentioned that no one's really selling or buying at these levels.
Yeah.
There's a very slight move towards call options week on week. As you can see, there's like sort of converging for out of the money call options just on that far corner. But and there is a more significant decline week on week in terms of these put options. But at the end of the day, price has been more range bound over the previously to these past few days.
If you go to the open interest on the strikes, because that's the one we've been looking at week on week.
Yes. So just on this, the $90 call option has seen a small reduction, which could just be profit taking over the past few days.
Yeah, but there's a pretty serious increase in the 70.
Yeah. So that's interesting because the this especially shows, so that the blue line over there is the $70 call. And you see that increase over the past few weeks. And it's really interesting because open interest in that is now at around 30,000 lots. If prices continue to trend upwards around the $70 strike, we could see delta hedging cause the writers of these calls.
Yeah, but that's always the case, so depending on the range.
They could start.
What's interesting about that is clearly there's more, we were definitely seeing the call put skew. So basically interest in the calls versus the put, more to the put side, but it seems to have skewed back to the call side a little bit. The momentum is picking up from a price perspective, and volumes being increasing. So it's all indicative of me of like people actually believing in a bull run now. So if you actually add to that, WTI Brent was narrowed to almost -2, which is quite historically significant, or is recent historically significant. The spreads are WTI time spreads are leading. They're rising. Brent spreads are also very strong. We talk about margins forever, but it's getting into the media more now that the margins are strong. So it's a pretty, all the factors we would consider generically as a pretty strong bull run. So market's starting to believe in this, it seems. And I guess this is a combination of real fundamental signals, maybe with the margins and things like that, and the physical crude differentials, but also a bit of relief on OPEC not basically bringing back as much as initially thought. Or the hysteria around
well, I was going to say, when you said about WTI Brent being so high, so I mean, does that suggest that this rally is WTI driven? Or
usually, is it just, I would say,
yeah.
When you see a crude rally, a flat price rally, the first thing we always do is look at WTI Brent.
Yeah.
Like, did it come from WTI or did it come from Brent? Like, then you can kind of work back from there. Was it producers or was it speculators, that kind of thing? Just generically, right? Trying to piece together something. But if it's WTI led and the call increases and all, I think we'll go into more of the detail, but the point is that it looks like hedge funds in the US basically.
I was going to say, does that kind of suggest that maybe hedge funds like in the US are sort of driving some of this momentum?
I think it would make sense, but let's unpack it in a bit. So that's generally, summarized as heating up, you have to say. Like, I wouldn't quite say hot, but it's like teetering on. We've been here before, right? Where it looks like it's about to blow up to the upside and it kind of calms down again. So it's an inflection point again, right? I mean,
yeah, for sure. But you can't deny that, like you say, it's heating up.
Yeah. Okay. Yeah. Well, let's go to the next section then, which is the herd mentality. So what would be driving this herd move upwards then? I think we just kind of half mentioned it with OPEC being a bit of a relief rally almost on OPEC not being overproducing as much as initially reported. But go on, you go, Mita.
Yes. So I was going to mention OPEC as well. So OPEC supply continues to be a key market driver. Yeah. We've had different forecasts of OPEC's future supply and how much they're really bringing up. I think that's still a point of debate in the market. With Goldman Sachs saying we should see one more hike in supply, while Morgan Stanley saying we should see 3 more hikes. Morgan Stanley specifically said that this shift that OPEC's having in like bringing up oil production quotas not really translated into big gains in oil output, which is something we've also been seeing for a while now, just in terms of the overproduction. As for example, for our viewers, May 2025 OPEC quota for the UAE stood just above 3 million barrels a day, although Petrologistics data had this value at 3.8 million barrels a day for me. So that's
very different.
Yeah, I've got this chart over here just to visualize that further. They're well above their 5-year averages. So so just even with them bringing back barrels, I think a lot of the markets not really.
People are starting to realize they're just bringing it back to what they said they were actually doing before. It's not
exactly.
So we talked last week about trying to forget OPEC a little bit because we just got to look at the fundamental signals. And I think, like Morgan Stanley said recently, and they get a lot more press than us, right? And they're saying, okay, well, clearly the actual production is not coming online. There's no signal that it's actually like oversupplied basically. And now once the market reads a headline like that, it can react to it. And that's why we call it herd mentality, right? Because generally the markets move from these buyers and sellers. And ultimately, I guess we probably should have been more bullish on the back of that in retrospect, right? If we didn't feel the market was really paying attention to this, which it turns out I don't think they really were. We've actually had talks about that in the trading floor, like people speaking to hedge funds saying they kind of missed this whole underproducing Mervyn story that we've been talking about,
right?
And now they're only just reacting to it. So it was a bit of an inefficiency in the market, to be fair, and probably does explain quite a bit of this recent rally. So I think, that's just a classic example of how you have to know what people are responding to.
Yeah.
And so now that they've responded to it, I also saw the refinery margin stuff we've been talking about as well, but then the margins being very strong. I mean, that's been like 6 weeks of content for us, but that's now come out on Reuters and people are now talking about that just when margins are starting to get compressed. So it was classic. But the point is still the same, is that if the market now is aware of that, they're more confident. So you've got OPEC and you've got refinery margins. There's two good regions to be speculatively buying.
Yeah.
If you've got like a generic view on crude futures. So kind of all makes sense that the recent rally has basically been reacting to this stuff.
Yeah, and that would match up to what kind of hedge fund typically would react to and start buying crude.
And they do tend to move in herd. They like to see the Morgan Stanleys, the I don't know, the energy aspects start to confirm these things. So it kind of does all make sense. All right, anything else on the herd mentality that we should be aware of?
EIA stats were really important last week.
Yeah, fair.
So last week we saw significant product builds despite crude declining by 4.2 million barrels week on week. So I've got, if you look at my chart here, I've got builds in gasoline and distillate. So gasoline especially, we saw that build take stocks right up to last year's levels and very close to the 2024 average. And yeah, so this is really significant because this was a 5.2 million barrel build week on week at a time where we should be seeing more draws.
Yeah, it's a bit of a mixed picture. I mean, you've got gasoline, I mean, not exactly high stock seasonally, but building when it shouldn't be building, that's for sure, implying like, you know, you've had lower prices and you've got summer peak demand and yet we're building. Yeah, that is a big significant thing. But you could also say it's bullish crude because they've been ramping up utilization and the market hasn't yet had time to digest this like huge increase in product that's coming out. So give it a couple of weeks, it might change.
So this build was also primarily driven by a decline in product supplied, which is a proxy for demand.
So demand.
Yeah, so it's
supplies
product
to
supplied. So that's that essentially looks at refiners supplying to say pumps and end users. So that's a good proxy for like demand. But so it saw a massive decline last week, which is bad because it's indicative of low demand. But at the end of the day, it'd be interesting to see this week's stats because that particular data point could have also just been an outlier with pumps, say, perhaps over-prepared for Memorial Day weekend. They probably didn't need stocks that week. So a lot of things could have driven that decline in demand.
Yeah. Do you know what else? If you go back to that graph, I think the jet one is surprising. Like we're basically at the all-time highs on the stocks for jet and kerosene, which, you know, incrementally it's a lot less, as you can see, right? 44-ish million barrels compared to heating oil and distillate at 110. So it's, you know, it's half the stocks. So, but even so, you would expect, it's basically the wrong way around for me because I thought there was a hell of a lot of airline demand. That was where like all the travel was picking up and that was where a lot of demand this year was coming, certainly from places like India. And yet it's the other way around. So I don't know where the increase in distillate demand is coming from. And we have had decent rallies off like certain stories here and there, but it's the most surprising thing for me because basically from a crude supply point of view, distillate shouldn't really be doing strong, and there's not been like some huge global demand story. If anything, the macroeconomic environment that's very linked to distillates has been weak. So to see the stocks that low and to see jet so high, it's all basically completely out of whack. So I don't know how much you can read really into this. This is a refinery story. Maybe it's even got something to do with the Canadian oil sands.
I was going to say, could this be just a sort of like the slate that's been running in refineries and they're just pumping out a lot of jet fuel and Caro and I mean, I don't know.
More naphtha as well linked to it. So you could argue, it's been a lot more yielding after all the disruption to like Canadian sours and Venezuela and all the sours that produce more distillates with these high quality refiners in the Gulf Coast. If they've been forced to use more Midland and more shale and all that, then that would actually make sense, wouldn't it? So it could just be a function of that. So I don't know how much we can read into this, but I get your point. For gasoline to be building is just generically as a macro story pretty alarming for bulls, at least in the States, and coming into the peak demand area of Q3 and where people like to place their bets on the bullish side. It's not great. But we'll talk more in detail about some of this in later sections. But for now, let's get back into the minutiae with the OPEC story. Let's cross to the officials. Oh, I thought you were in my office. Oh, you are?
We are.
I can't really tell. Right, where's Wally? All right. So guys, so we were just saying, right, so you've got the market starting to, as in mainstream media and the wider hedge fund market, the wider kind of stories around oil starting to put some significance on this OPEC production disparity with what they say they're going to produce and what they already have been and that kind of stuff. What are now the allocations, the Saudi allocations? Like, what are they? What's going on? What are they telling us about the market?
Yeah, so they came out this morning that the Saudi allocations to Chinese refiners for July are going to be pretty consistent month on month from the June allocation. So we're going to see 47 million barrels sent over, and basically they've just shifted around a little bit between the refiners. Some have got a slightly higher allocation, some are slightly lower, but the overall picture is pretty consistent. That's really what we're expecting because the Saudi narrative has been pretty consistently about this kind of steadiness and stability in the market that they want to try and support. And following the OSPs, it kind of makes sense that they want to reassure the market there's not going to be a massive, like a deluge of supply going into China, because with the OSPs last week, they cut by less than the structure would have implied that they could have done. So really, I think it's a story of the Saudis. They're not producing as much as the market perhaps did fear. And as a result, the allocations have come through as expected. But will you something to add to that?
Yeah. So, we know that China like to buy on a flat price basis. They tend to buy opportunistically when flat price is low. So it's not really too surprising that we're seeing allocations are pretty strong actually on a historical basis. I mean, if you look at the chart that we'll show in a second, the last 3 months have been really pretty strong allocations. And what we got this time was a bit of a pivot in strategy on the OSP side from Saudi Arabia. So for the last 2 months, we saw that they would cut by more than the structures would imply or hike by less. So that's pretty generous on their side. Whereas this time it was slightly different. They cut by less than the structure would imply. So structures implied 40 cents, but they only cut 20 cents per hour blight into Asia. So perhaps that's walking back some of those previous handouts a little bit, trying to regain some of that. But I think it's more kind of giving the market, as you said, a signal that they are not going to engage in a price war. And we've seen them producing, as petrologistics data would suggest, pretty underquoted. They're being pretty pretty restrained.
The only OPEC member that is actually holding back, it seems.
Yeah, and I think also the allocations speak to another aspect of that they give a bit of clarity on the kind of demand picture in China as well to a certain extent. Because I mean that's been a big concern for a lot of the market is what's going on with demand in China. And last week we got the Caixin PMIs printing soft. They came in below expectations, but then in the equity markets they leapt on the news that the CSI was up on the day. It seems to be one of those kind of bad news is good news because that the CCP are going to come out and inject a bunch of stimulus.
Yeah,
we've seen the local government debt issuance is up, and all of this is going to be good for Chinese oil demand. So I think it's more of that same opportunistic buying now ahead of rising demand.
That also fits with the question of China building its inventories for crude inventories because they've reached an all-time high on their crude inventories according to various sources of data. But based on people I've been talking to, some are starting to question how long that can last. Like, how long is China going to keep building these massive inventories for?
I mean, they're in some pretty heavy turnarounds at the moment. So, like state-owned utilization is only it's about 77.5%. Independents broadly across China at like 63%. But in Shandong, they're running below 50%. So, they're undergoing some pretty heavy turnarounds, and that's meant to kind of pass through come August time. So that then we'll start to probably see some of those inventories start to be drawn on. But yeah, no, for sure, it's definitely interesting color on what's going on in China.
Yeah, one final thought I'd like to mention as well as the Saudi OSPs, we got the ad hoc OSPs last week, and for July, Opazakam still has a 10-cent premium over Murban, but we'll see if that continues into next month, given the given the changes to the Murban export schedule and the Dubai window that we're seeing. And fuel oil likely coming off now. So that's one to definitely keep an eye on for next month.
As you're talking, it just comes to my mind. It's always a good reminder just how quickly incredibly large economic shifts in sentiment can happen. I mean, it was only 2 months ago, I think, maybe even less, that our view on China was it was very weak. They'd done some buying, sub 60 on Brent to fill inventories, but they're not there to be the sustainable demand growth that we need to get the balances in order. And then all of a sudden it completely switches. And that's the thing. It's like, you don't really know what to believe. I think you have to, that story, the OPEC story, it's just a reminder that the world is heavily financialized. Governments and organizations, they all know the market's financialized. They all know that sentiment is one of the biggest things in the economy for prices and for general shift in money flows. And they're all trying to game it all the time. So you're going to be fed crap, but also, strategic moves all the time. And it's just a reminder to always be on the edge of your seat. And I guess having like your own confirmed kind of view that doesn't move around too much with the noise, because as you're talking, everything is looking really bullish. And I think it's going to be a recurring theme. The more we break down all the things that we typically break down, we'll say it's bullish, bullish, bullish. But the White House will come out with something soon. I guarantee it. Yeah. Because it's getting to that level where it's against the Trump administration's mandate. Anyway, thanks guys. And we'll move on to the next thing, which is the hedge fund watch. Okay, so this is an important section for this week because, well, we just alluded to a price rally probably coming out of the US, but maybe in the UK or Europe as well from funds. So we've got to look at the positioning, right? Let's start with the CTAs. Again, the theme has been the CTAs have been short. They trade on a momentum basis and they're very influential on the price. Open interest has been declining or increasing. Let's start with that on the CTAs.
Net positioning in Onyx's CTA model for the crude futures, Brent and WTI, has been increasing. So by net positioning, I mean longs minus shorts. So they still remain net short overall, but net positioning has increased by 32% week on week in Brent futures.
Sorry, when you say it's been increasing, do you mean?
So we've seen them be less short over this past week.
Decreasing open interest, right? Because the shorts are closing out.
So it's net long positioning. So it's net positioning is always longs minus shorts over here. So yeah, net short positioning is declining.
Yeah, so that would mean open interest is declining, right? Because they're buying back what they're short. So from a CTA perspective, they're de-risking. So de-risking from a CTA perspective is bullish because they're short. So that would all make sense. We've talked about this a few times, how this is the big threat to the bear story, because if this gains decent momentum, it can all of a sudden switch way onto the bull side, right?
Yeah, I mean, like you said, they're still net short. So even just from kind of liquidating, like partial liquidation, we're still getting that kind of move up. And then, if then there's momentum and a move higher, then there's, they're effectively flat at like a higher level. So yeah.
Yeah, lots of momentum still to come. But again, we also talked about this, about the metrics they use. Just on a short-term price rally, they're not going to react. It needs to be there sustainably for them to switch the positioning. So we have been out of this $62, $63 range for a while now. So it makes sense that if you bring forward the kind of average of the prices, that it's getting towards more, well, you need to unwind the short. So it kind of does make sense. So let's say they're decreasing open interest there. So where is we have seen open interest increases. So what have the money managers overall been doing on Brent and WTI, I guess?
So for money managers specifically, so overall open interest in Brent futures has declined, although open interest by percentage of money managers has increased. So I'm just going to plug in our CFTC report over here. But if you look at that, this increase has come amid an increase in long positions and short positions. So the little red dot over there, that's net positioning. That's been fairly stagnant week on week for the past 4 weeks.
Okay, but we know that the CTAs within this, right, have been decreasing the open interest, which means discretionary money must have come in quite a bit, or risk parity, which is the macro portfolios, right? So there's actually, it was Goldman's. They said buy oil and buy gold as inflation hedges, and this makes sense because it's in line with the Trump increase in spending. So that's inflationary. So bond market does what it does, but also people start to move back into oil from a macro perspective. to hedge a wider risk against inflation. So that would probably be one of the leading indicators. And who's going to, I mean, WTI, generally speaking, I would guess, probably need to prove this, would have more of that money than Brent. Does that come in the stats?
Yeah, so if you have this, so we've got this for WTI futures as well, and that's a lot more significant increase in long positions this week.
So that WTI Brent rally could just, doesn't necessarily mean it's kind of physically driven. It could just be financial purely from just like a driven WTI.
Yeah, and actually it was one of like our favorite trades I remember years back, because what would happen was in 2014, I don't know if you remember this at Mandara, it was like a big rally on the basis of, 2013, on the basis of basically wars going on in Syria, like the Obama red line stuff was going on. So people would pile into WTI to speculate on it, and it would drag up the time spreads as well on WTI Brent. And it would get to the point where it's so high that physically it's like, this is ridiculous. So all the Cushing guys who had storage would just flood the market at those levels because it's just such a good time to take profit. And that plus the leveraging short, the spread would just collapse into expiry. You're just giving the physical guys all the leverage. And but yeah, exact to your point. Like, it's just people get too carried away that it actually inflates the fundamental scenario, and they forget they're trading a spot contract. So yeah, I agree with you actually. And I think WTI is one of those ones where it's used probably less for buy side hedging than Brent is from a end user perspective. And so the buyers tend to be more speculators. And so I think generally speaking, like you're basically bang on. I agree with you. It's a speculative led rally from what it seems, because Cushing clearly hasn't been that tight, right? We've had bills and demand's not great. I know there've been fixtures moving over WTI Midlands, hearing from traders, decent WTI Brent like block trades, like 2 million barrels at a time, which is a VLCC, like a lot of oil moving over. Lots of WTI Midlands being offered into the dated Brent window. So there's all the indications that quite a lot's moving over, which is kind of bullish WTI, but not to this extent. Unless you want to say the refinery utilization has been going up, which we'll cover in the Chronicles. But anyway, sorry, you were saying?
Yes, so just to add to this being a spec-led rally, net long positioning among money managed positions in WTI futures is now at 144,000 lots, which is the highest level it has been in since the week ending 28th January of this year. So it's been, so this week's rally specifically, this week's increase in money managed long positions has been just that significant, which I completely agree with Harry, could just therefore be what's driving these prices up.
Yeah, I think this is actually really significant. Again, this is the point of this, right? We're trying to use all the different segments to gain like a true picture. And as you talk it out, you realize, we could be inflated, basically, that there's an indication that we're probably inflated on a price perspective, at least just on this basis. But let's get more into the fundamental information, and I guess. So let's now do the crack spread Chronicles. Okay, so this is where we look at the refiners and their economics, what they've been up to. So what's the narrative we're saying here? That the it's bullish, maybe highly speculative driven financial flows. But having said that, there is a good margin story here. There's a good relief rally story here from OPEC. But at the same time, this feels like a lagged story, right? The refinery margins have been coming off from their highs. So how would you summarize their activity, or what have you got to say, Mita?
Sure. So going back to the CFTC data, so we've got over here long and short positions in the producer merchant category for RBOB futures, that's US gasoline futures. It's been risk off this week. We saw longs exit by 16.8 thousand lots and shorts exit by 8.5 thousand lots. And you can see that decline in net positioning as well this week after being stagnant for previous weeks. So it's definitely there's definitely more de-risking among these players. Interestingly, I know we're talking about hedgers over here and like producers, merchants here, but even in money managed positions, RBOB saw a significant removal in longs, while shorts were added by a muted
But that
amount.
makes sense from our story around the storage, right?
Exactly.
But in terms of going back to what you're saying, the reason why you brought this up was because the producer merchant section, which is the refiners who on the sell side, they have been increasing their positions on the short side, or
they've
barely,
been
right?
removing. So they've removed their positions. Shorts went down by 8,500 lots this week.
Okay, so it indicates there's not actually been that much refinery margin hedging, at least in the US.
Yes.
But there has been in the UK, or as in Europe, trading hours and Europe contracts, we've definitely seen refinery margin hedging. So that is quite interesting.
And there has been refinery margin hedging in gas oil.
Okay.
So looking at the chart again, producer merchants were seen adding 12,000 lots to longs and 23,500 lots to their short positions in the week ending 3rd June.
And again, it is high. I mean, $17 odd on the crack for gas oil, and I guess heating oil is going to be slightly higher from memory.
So heating oil followed something similar to gasoline. Unfortunately, it's gone down. It's been more risk off this week. There's been some.
Okay, so it plays into the narrative that European refiners, European-led contracts, they have been hedging.
Yeah.
Whereas the US, opposite, right? They've just been more speculative money has come in, and refiners are happy to take the profits that are there from seemingly. So they don't seem to be too worried or seem to lock things in. But again, just generally what I'm saying is the distillate one is the one that interests me the most because it's still very high. As in, when I say very high, I mean, look, on the wider historical range, obviously compared to 2022 and 2023, it's not that high, but it's stubborn, right? And fuel's also high. We've talked about this. Is really the combination is really supporting heavy margins and refinery margins overall. And this is what led us to keep going on about it, right? Refinery margins are not meant to sustainably be this high in oversupplied markets, because we've been told by supply and demand balances, and the general theme has been we're oversupplied, but this indicates the complete opposite, unless something's just been propped up and we're about to collapse. And that's what I wanted to emphasize, right? Like, are we due, you know, now that it's in mainstream media and in everyone's attention that the refinery margins are strong, they've said that just as margins have taken like a 20% hit. And is it now kind of all over and everyone's going to flood and more product and it's unstoppable? And this is the indication of an oversupply. But have we got anything else on refinery activity or how people are reacting to this?
So we've got margins over the past week. So I'll just go back to this. So weekly changes in Asian refinery margins and European refinery margins show a decline this week. Although, despite the fact, as you can see, all of the products have contributed positively to the margins, just that crude's been a lot more strong, and that's dampened margins, at least our calculations of the margins. That said, if you look at the product component, it is interesting that in both those, gas oil and synced and ppm diesel has been the most supportive of margins.
Which makes sense because it's the biggest yield. But I think, okay, it's good we brought this up because this is making up the strong margin at the moment. Now, the DFL rally, so that's and the Dubai rally, this is the basis of the crude, right? So it's just indicating that refiners have been paying attention. They've been buying more, raising their utilization rates, buying more crude. And it's compressed slightly that the margin because the crude premiums are going up because there's buying. What is the oversupply, or what has that led to in terms of product supply? I mean, it's dampened, but not hugely. I still think we need to focus and zero in on the fuel oil. So this is just our basic benchmark. We've said roughly, I think if you combine 3.5% and 1% Northwest Europe, you've got about 10% of the margin is fuel oil cracks, which is quite low actually. For Europe, I think it's probably higher, generally speaking, obviously depending on the crude you run. But at the moment, the fuel cracks are strong. So if we were to say, right, how much of a sell-off do we need to see in the fuel cracks to start weakening the margin? Maybe we could do that with the dashboard, right? If you got that up.
Yes, I've got that up.
So this is the margin dashboard that's available on Flux.live, and you can play around with your own yields and using our fair value curve. So right now, okay, you need to customize this, right? So if we just ramp up like the fuel oil to, I don't know, something like 30%.
Yeah.
But let's make it 26 because you've already got low sulfur fuels 4. So if you do that 26 and then make the difference in gas oil that you've increased, 26 there. Yeah, and then reduce that by 14.
Yeah.
That would be like a bit more indicative of like some of the cheaper refiners in Europe that are geared towards making gasoline. Yeah, so that does get it to around 387. Not too bad, right? I mean, profitability is very hard to know. You kind of have to involve like gas prices, even hydrogen prices for running the refinery, electricity and all that. And obviously the workforce and all that. But you could probably safely say around $2.50 to $3. You're kind of worried about profitability at that level. So if fuel does, at the moment, fuel where it is, it's still profitable. But if fuel now goes down, $2-3 per barrel, which it easily could, right? That's like, you're looking at like a third of the margin on that basis. So you basically, I guess, just divide by 3. So that's that dollar decrease proportionately, the $3 crackdown move for $1 on the overall margin will threaten profitability.
Yep.
You see what I'm getting at?
Yeah.
So all our story about fuel oil oversupply.
And that's assuming, that like the kind of the other products will hold it up, because naphtha also looks, another kind of waste product, naphtha also looks,
and it's trending down, right?
fairly sort of wobbly. So if those, like in the same vein as fuel, if those waste products really start to fall, I mean, I don't know what the percentage of naphtha you got in there is.
I've got
11% or so.
Yeah.
That's kind of what 40% of the margin or something. And if there's a decent trend down in there, then you're definitely starting to play to threaten that kind of $2.50 a barrel level, like, quite easily.
Yeah, so we have to pay attention to this, right? This is probably the most important thing, because if the market is probably in its most bullish state all year, in the sense of refiners ramping up, peak demand Q3, so it can survive this period for a couple months. But if the glut does arrive, or like the oversupply does come from these sustained high margins, particularly in fuel and naphtha, like you say, it will compress very quickly, and all of a sudden
you're almost kind of like kicking the can down the road and making it even worse, like the longer it goes on. Like you're just going to have this like enormous build up.
And then all the refinery margin boxes, right, like the backwardation and the cracks, is that you're already rolling down lower, and it could really threaten profitability.
Yeah.
And if that does happen, well, it's kind of a really bad scenario for bulls, because what will happen is the European refiners have been hedging like mad. Like, that's the evidence we've seen. So they're not going to slow down. It takes a lot for them to pull back operations. So they're going to keep going, and the market can't take it. So the cracks have to go lower and lower and lower to price in more demand to clear out the excess. You could be into negative margins, and then we're looking at another bear story, and we can finally say the market is oversupplied. But we don't know, right? Fuel could have another rally.
Well, like you said earlier, like you use the word stubborn.
Yeah.
I feel like that is probably just like the most perfect word for what's been going on in this like margin thing. We talk about it every week, and then we're like, when's it going to happen? But stubborn is the word. It's just, it is incredible. Like, I think in the first week we talked about fuel, and we were like, these things are quite often short-lived, and it can often just be a flash in the pan.
It's been like 6 months. Okay. So that's the state of things. How have refiners been acting? Just to confirm, like, utilization is up in the States, right?
Utilization is up, but one thing I was thinking about in terms of heavy fuel is that there are wildfires in Canada's oil-producing province of Alberta. So just looking at Fort McMurray, which is an important area for the Canadian oil sands, there have been wildfires that have affected more than 345,000 barrels per day of oil sands production. So that, considering the fact that Venezuelan, with all the US sanctions story, Repsol, for example, has completely dried up its purchases of Venezuelan crude. And just, I think that could be important for fuel oil as well, just looking at that supply of heavier crude.
Yeah, this is the other thing about the physical market. So if Repsol signaling that they're buying less, it's massively lagged, right? So the market is trading future barrels always. So the market has been saying there's no fuel barrels out there, because maybe, as you say, the Canadian and the situation with Venezuela and OPEC again, Al Shaheen was being used by the Abu Dhabis instead of Murban and all that kind of stuff. So they are pricing in these indications and trays and physical when it's not produced. So then you get the reality of that in the physical data. Okay, Repsol haven't been taking heavy crude, but something could have shifted again, right? Because we're now talking about the future barrels now. So is there going to be more fuel oil supplied? I mean, I know we're going to be talking about fuel as the deep dive a little bit as well. I think there are indications stocks have normalized, and Fajira, I think Martha was saying yesterday in our talk, and in general, like, I'm going to err on, because I'm so clearly biased, because I have the view that fuel is going to collapse and the glut's going to, but trying to be objective about it. It's definitely exhausted, I think, all its kind of like hyper bullish reasoning, and it's priced in a hell of a bull rally. So
Definitely. Yeah, I think this wildfire news is also from 3 weeks ago. It's just interesting that no one's really talking about it as much, considering 345,000, it's 7% of their crude oil production. It's just interesting to me that...
But most of it goes to the US, right?
Yes.
And the US then they don't produce any fuel.
They don't produce any fuel, really.
If anything, they're producing a lot more gasoline and distillate. So distillate stocks being low in the US might be an indication of the slate again in the Canadian oil sands. That kind of does make sense again, right? That the US have been struggling to produce that.
But fuel is almost like negligible in the US in terms of...
Yeah. Okay. Anything else on the crack spread chronicles?
Just your question about refinery utilization. It did increase 3.2% week on week. So it's currently
3.2%.
It's currently at 93.4%.
This is in the US.
Yes.
So that is enormous, 3.2% week on week. So finally responding to high margins, but they're not hedging in the open market off the back of it. Fair enough. But that's pretty incredible, actually. I mean, such a big increase. You have to say that's going to be why gasoline built. I mean, I think it's a bit, well, it's not going to be that instant, is it? But I would look out for that. You don't necessarily want to jump to conclusion that gasoline's that weak. It is giving the indications, like you say, what's actually supplied to pumps and all that. But when utilization is flying around like that, you need to kind of let it stabilize before you make like a concrete argument. But no, that makes a lot of sense why WTI has been stronger then. Again, maybe just speculative reasons, people are responding to that statistic, but that is bullish, like undeniably.
Yeah.
Okay, so a new theme, we're going to look at the pump prices, kind of been alluding to it. So you've got the refinery margins, you've got refineries produce, and they do that on the back of economics, where the demand is, all that kind of stuff. But let's look at the actual pump prices now, because this is a reminder that everything we're talking about has very real world implications. And it's just about translating the language, right? So we're going to do our best to do a little segment on this to kind of emphasize that. So this is the pump perspective.
So just, I'm going to first focus on the US, just with everything we've been talking about with refinery utilization and pump price and just in general, the weakness and the build in gasoline. So summer driving season is underway, as we have said, and this is around the time where you would see a rising demand for gasoline. And a lot of times rising demand would traditionally lead to more expensive gasoline prices. But this year, natural gas prices in the US, that's natural gasoline prices in the US, are an average of $3.14 according to AAA. And so over here, as we can see on this chart, that's the lowest it's been in recent years. So yeah, their perspective on it is oil supply outweighing demand. Everything that we.
Well, this is the link to the wholesale market. So we're around 65 in WTI, which is a good $5-6 lower, I would say, than the average of last year. So this all makes sense, right? That the outright price is lower wholesale, it leads to retail, it's lower in line. That makes complete sense. But I guess it's interesting. We've had lower prices, which is lower inflation, lower bills for the US. They're very sensitive to this. Yet the indications are we haven't seen an increase in demand, which is actually probably the most surprising part.
Yeah. I mean, I suppose they're just, if anything, that speaks to the just whole like kind of cost of living squeeze that, has been like talked about in the kind of more like macro.
I actually don't know. I mean, maybe it's the knock-on effect from these tariffs, and people have been saying, haven't they, that just because you're not seeing immediate economic data on a fallout of all this drama that's been happening in the US, you will eventually, and maybe this is starting to see the implications. Like people just generally have a weaker sentiment and buying activity, and they're probably worried about the dollar weakening and all this kind of stuff, right? So maybe just an indication of fear. I mean, generally speaking.
Yeah, I would say so. I mean, I think like it's hard to know what the sort of average American is thinking about what's going on, but I mean, it would make sense that they would be kind of fearful, and they've had to like battle with inflation like we have, and the average consumer is probably feeling the pinch. And even if you've got a lower gasoline price, is like is that just been totally offset by the last 12 months of inflation and egg prices being at like all-time highs or whatever it is?
Travel is the theme that's interesting to me at the moment in the US, because if they're not driving as much, and I don't know the exact jet statistics in the US, but the stocks are certainly building from a supply perspective. It's kind of indicating it's really dying down in the US in terms of their travel between states and general driving, which is pretty bearish the economy.
Just to add to that, diesel prices have also fallen. So they're currently at $3.448 a gallon, which is again the lowest since 2021.
Yeah, but again, in line with wholesale prices moving down. So
this is again just like a little bit on national retail price and how they differ. Again, they've just been declining through on a national level, despite being different just according to taxation and whatnot. But just looking at the RBOB seasonal chart as well, very similar story, as just to allude to what you said about the wholesale prices. We
don't need to keep emphasizing this. This is the outright price, but I guess that's US. What about Europe? We got that as well.
Yes, so this is a heat map that we have for the E10 price. This is a
Wholesale
comparison-
gasoline.
Yes, wholesale gasoline price for 10% blended ethanol. And that's a difference from 6th March to 9th June.
Yeah.
Green means cheaper, but we haven't necessarily seen that translate into demand again, like similar to the US.
Yeah, I think another thing here is indicating how, if you're listening to us speak and we are saying that the wholesale gasoline prices have been rising, let's say we're in June and we're trading June contracts, but the main contract is July. It's always 1 month forward. And that's in turn priced by some July, some August barrels. So it's very delayed, all these things. So you're getting an indication of August prices right now, certainly July prices right now, and July demand, at least from a wholesale perspective. So if prices are lower now, prices are higher now, you won't see that in the retail pump price for another month or two. So the fact that prices have been weakening in the UK in gasoline from May to June is in line with the fact that the market moved down quite aggressively in May on an outright basis, right? Brent came off, gasoline was weaker in Europe. So that all makes sense that now the prices are cheaper. But on the flip side, prices have been rallying quite significantly, maybe as much as by 10%. So you should see that filter into higher retail pump prices in your local stations in the UK. And let's see what that impact really is. But you've got to say that the markets in the retail pump price are much more sensitive to the upside in wholesale prices than they are to the downside. It's not surprising why. They basically take advantage of that and raise prices locally.
Yeah.
So, I mean, 10% increases, maybe even 15% increases could probably be expected. And we're around, what, 135-ish?
135, I think,
Yeah.
was maybe a bit cheaper for gasoline, or
Okay,
No, it's
around that.
okay, 135. Yeah.
So we're talking between forecasted maybe 10 to 15 pence per litre increases in the next couple of months, potentially, right?
Potentially,
We don't know, but that could be the case.
Yeah.
Okay, now let's go back to the market and who's been winning and losing. This is the gold rush. Okay, so generically, winners and losers.
Generically, just in terms of the discretionary money managers that we've been talking about throughout this podcast as well, I'm going to talk about the Brent futures contract.
And WTI, right?
And WTI.
The buying
yes.
that has been coming in from hedge funds has led to price increases. So you've got to say they're making money, right? I mean, that's fair.
Definitely, especially in WTI, which has seen this increase
Majority
in
of the
long
rally.
positions. Exactly, has seen majority of the rally and has seen a decline in short positions and an increase in long positions among money managers. So definitely that.
I would add to that, generally the market seems to me it's been more long the time spreads as well in WTI and Brent, and they've both rallied as well. So that does kind of make sense. But I would caveat that with, it's been reported that a hell of a lot of volume is going through in the back end time spread CSOs. So this is the calendar spread options. So the options on time spreads and kind of deck. So the next year's time spreads that, you know, everyone's calling again for a massive oversupply. People have been betting big in the industry that that's going to transpire, but I guess they don't want to short it outright right now because there's quite a bit of volatility and it's bullish in the front. So instead they're buying CSO puts. In other words, they're buying put options on time spreads with strikes. I think it's around like -40 to -60, kind of that's where they think it could get to next year.
Right.
And that would be the payoff. So yeah, you got to caveat that. Like they might have been long the front and long spreads, but they've actually kind of got offsetting long-term positions. But yeah, sorry. Anyway.
That's interesting because I was going to add that just in terms of CTA and how we've seen that positioning also decline and therefore net positioning go up as well. I think also just further supported the discretionary hedge funds who have been going long Brent and WTI. So yeah, overall that would be my gold rush. Because in terms of momentum indicators as well, which is what a lot of people might be looking at, we've seen that flip to,
Well, that's what the CTAs have been reacting to, right? The momentum shift, yeah.
Exactly. So we've been talking about Brent moving around this triangle and we have broken past it, which is significant. So usually a triangle means that you're just oscillating around, like mean reverting around that range. And then once you break out of it, that's often a sign that you're going to keep breaking out in that direction that you've broken out in. So over here, it is upside. So I think a lot of people would be looking at that and just looking at how that's going to react to, say, the 100-day moving average and just certain resistance levels like that. And momentum indicators, what, as you mentioned, the CTAs would be looking at as well, have also flipped positive. And that just means that longer term moving averages are below shorter term moving averages, just to show this recent momentum rally.
Yeah, got it. And then what about more niche? So in the swaps market.
So more niche, I'm going to talk about fuel oil. And in terms of fuel oil, I'm going to talk about the 3D East-West, which I think just with all the confusion about, or just the diciness, so to speak, and like with how sustainable this rally in fuel oil is, a lot of people might be looking at differentials. So the 3D East-West would be looking at the Asian 380 high sulfur fuel oil versus the Northwest European 3.5 barges.
It's basically Eastern bunker prices, essentially, right?
Yes.
That's where the strength in fuel has been led by, right? It's the East. So you're saying that now that the outright cracks or the fuel versus Brent prices have gotten so high, there's still strength in the East, but the cracks are just getting influenced by varying factors, right? Supply from refiners, that kind of stuff. But it's still a high percentage trade to be long East versus West, because
It's a nicer way of you take out the kind of noisy bit, which is now the cracks.
which the market has been doing, right, Mita?
Yeah.
Is that what you're saying? And
Yes,
it's been long and it's made money.
Yes, that's what I'm saying. So I can just get this up here. So I've got this up on my screen over here, and you can see that increase in trade houses towards the end of the week. So this support emerges alongside a bullish physical picture as well. So on 3rd of June, we notably saw 21 cargoes of HSFO, high sulfur fuel oil, bought by physical players. This was equivalent to around 480,000 metric tons. And this was all done by a few traders in East Asia and the Middle East.
Okay.
So that's really significant. And again, the Balmo East-West, so that is the current June pricing East-West, surged to above $27 when this happened. And we also saw buy-side interest in the contract from Chinese players and a Singapore-based trade house. This specific is on the dashboard is for the July East-West, so that's the month forward East-West.
Mm-hmm.
And we see similar trade houses buying this contract as well.
Got it. And what the entry price is roughly?
So for the July contract, we still see that longs are in the money for over the 90-day period. Again, it's important to see that after that decline on 2nd of June, we saw long positions. We saw
So long-term,
prices go above their entry levels again.
hang on. So the 90-day long entry price is 14. And sorry, we're about 15, 16, is it?
Yeah.
Okay, so to be fair, they've only been making money recently, right? It's a recent rally. So that, again, makes sense, as you said, Harry, like the nicer trade to reflect the remaining reasoning behind being bullish. If the cracks have been priced in, they've made their money there, now moving to more niche solutions.
Interesting that like if there's been a sort of, after all these months of like strength and there's now a bull play, I don't know, what does that say about confidence? Like, are people sort of almost like more confident in the market that they can like now prop it with physical as well?
Yeah, and we have seen that indication, right? It's been pretty nuts in the physical window.
Yeah.
Sing players have been buying pretty high levels, keeping it higher.
That's crazy. I mean, you think like to do that after so many months of like a really, really strong, like positive credit market. I mean, there must be.
But there's another way of looking at it, which is if you've been bullish and you've managed to keep prices so high for so long, you've made a lot of money, which you can reinvest in these physical purchases at a high level, right? So the longer it happens, the more money they make, the more they can take.
The more ammo. Yeah. True.
I would say that. And again, this all makes sense. It's actually playing out so well for the fuel market niche player, the big players.
Yeah.
Because if they've managed to do this, made a lot of money all year, they're now saying, okay, it looks like you could speculate that they're saying, right, I do think this is coming towards the end. So now I just need to start selling the back end, which is what we've heard.
Yeah.
They're starting to take profit on Q3, Q4, Cal. So they're starting to unwind and maybe even getting short the back end. They just need to see this out. So to see this out, you just start investing in the physical and the prompt, price it out, and then it can go. And it's quite a nice orderly way of ending this bull run. As you say, maybe as opposed to them being long cracks and trying to see that higher, now they're moving their risk to the East-Wests and the time spreads, keeping that high with the physical, which the physical is a time spread, right? The way it's priced. So you just don't need to worry about cracks anymore. So you can kind of price out your crack risk, start getting into short crack positions in the third market. All that time sort of risk gets priced out by your one last play this month.
Yeah, and so, if you've got some control over the physical as well, you know, when things start to turn, you can use that physical as bullets on the way down again, basically.
Well, this is it. So
you've got a short position and you've got a lot of physical.
And the confidence and the P&L buffer that you've been made. So if we marry the two, right, we've been talking more of a fundamental bearish gain potentially coming in basically because it's been so high. Refiners are just like, right, we're going to just produce as much as we can. Utilization is way up. you marry that with the trade houses who
Yeah.
won't stop it. It seems as if
Yeah,
they will stop it in the next month of supply.
Yeah.
But it looks like that beyond, they're going to go, yeah, cool. Like you can go down.
Yeah,
and we're
yeah.
not going to provide any support for that.
Yeah.
So this could be, again, I'm talking biased again, but I think this is talking.
Well, it makes perfect sense.
Yeah.
I mean, you use that physical as a bit of a loss leader. If you've got a highly leveraged short paper position and you've got control of some physical, you can use that as effectively like a loss leader to really kind of create the market condition that you want almost.
Yeah, but this is why we are so emphasize flow and positioning. This is our strength. I mean, there's endless conversations about fundamentals out there.
Yeah.
But you need what we're talking about here to marry it up
Yeah,
to know
100%.
when the timing's right. But the timing is starting to look really right to be short fuel.
Yeah.
Not prompt, back end. Like
Yeah.
sorry.
Yeah.
Okay, great.
To add to that, though, even in the prompt 3D crack, I've got this on my chart over here. We are starting to see that is a pretty significant decline. That is a roll down, to be fair.
it's a roll down.
But,
Yes,
after that, but even before that, we had been starting to see cracks in the crack, and then and we're still seeing price action, not necessarily.
But again, this is 380. So
Yeah.
because the East-West has been rallying, I reckon the European crack chart is going to be more
definitely.
reflective of a weakening
Yep. I can have
market.
that.
And if I was to be a betting man, which is kind of my job, I would be selling European cracks.
Yeah. The Euro probably feels like the better sell.
So that's the front month 2.5 arch crack.
Yeah, so if we get that up, that tells a little bit more of a clear story because we rolled down, I don't know, 20, 30 cents lower, but then it just kind of had a really bearish start to June, did it? Or relatively bearish start.
Yeah.
And then we know there's been back end selling as well. So this is only the prompt. This is the month one. The flow on the sell side has been coming increasingly from Q3, Q4 cal. We could probably verify. We might as well do that, right? Or if we get up Q4, or even let's say Q3.
Price wise or like positioning?
No, positioning. Or let's just do, I don't know, August fuel crack. So this is where, Q3 is where fuel demand was all being like gambled on, right? At the end of the day, this is what it's all about. You don't just say fuel is going to be strong. You say, when's fuel going to be strong? And you build a narrative, but then you also have a target price in mind, right? If you're a physical player or any player. And so because we've rallied so much, there's no need to be seeing it out into August because it's already had the rally you expected. So now you can take profit and actually get shorter. So has that been, what's the evidence on the positioning?
So it's been short, but we have been seeing some.
Oh, short. So if you go to the 7 day versus.
It has been, they have been taking off these positions. So the 7 day has been 70.
So they've actually been definitely long and they've been selling. So if you look at the Nov and Deck, okay, that's the indication. And so they've actually been selling Q4 way more than they've been selling Q3. So Q3 probably takes back what I said, right? They maybe do think this can survive a bit longer, but definitely Q4, you've said a lot of increase in selling there. And that all makes sense.
Yeah.
Okay, cool.
So
and
30th May alone saw a lot of selling. Yeah.
Okay. All right. So let's move on to the losses. And this is the Widowmaker.
So for the Widowmaker, I thought we could return to what we've been talking about, gasoline and the unseasonal build that we've seen.
Yeah.
And speak about that a bit. So this is just RBOB crack, the August RBOB crack. And so in terms of CFTC, we've spoken about this. Prodmarks unwound their positions. We saw money managers had a muted increase in short positions, but longs removed 1.3 thousand lots of their positions.
So stopping out is the indication. Long stopping out as the price.
Yeah,
is gone
exactly.
lower. Okay, yeah, that's fair. I mean, again, unexpected. And we did talk about this, Harry, didn't we? Like beginning of the year, we were super bullish gasoline, had a nice orderly rally.
Yeah.
Then just started to taper off. Good time to take profit. And actually, if you've been losing money from there, I don't obviously be judgmental because no one really knows what's going to happen. But there were the indications that the rally was exhausted, which surprised us. But
yeah, but it did look like that for a couple of weeks,
like
didn't it? Yeah, and then I guess when you had that sort of stat from last week, I mean, maybe the selling even
it
happened
would have
before that,
exacerbated
right?
it. Yeah.
CTA model, if you look at the CTA model, CTA positions are still going shorter. They have faltered a bit here, but they're still fairly low, which I think further pressured the money managers, as we saw.
That all makes sense.
Yes.
More of a niche one have we got? On the losses?
So just I think RBOB is still pretty interesting to talk about on a more fundamental level,
Okay.
which is why I decided to just focus on this, because even in the fundamental side, there was a bull play in ARA barges, so that's in the Northwest European barges, where physical players decided to take advantage of the open arb from Europe to the US, and therefore push more and more product into the New York harbor, which is the loading point for US gasoline. So this coincided with refineries in the US coming out of maintenance, which then saw the August rubber sell off to under $20, as we've just shown over here. This was further compounded by the bearish EIA stat reading that I was talking about. And the July ARB, that is the RBOB versus EBOB ARB, also sold off from $16.50 to 14 cents per gallon. It is seeing more support now, but it did sell off on the back of this. And we saw refiners and majors on the sell side. Even on the Scott dashboard, we saw 1 million barrels of trade house selling between 30th May and 6th June in the July ARB.
So basically just a bit of a fundamental storm for RBOB. You had like a lot of product moving, margins, margin hedging maybe, and just, a build in stocks, just a bit of a, the price couldn't really take the fundamental hit. And actually it's just a bit of a sort of repricing and some stopping out.
And if it starts to shift to a long-term bearish narrative, it's a little bit dangerous still. Because remember, the thing about summer is you've also got the utilization rates being so much higher in the US. What if there's a refinery outage, which always happens, right? It tends to always happen. If the market's getting complacent on the short side, we could have a decent, surprise event. And then hurricanes.
Yeah,
I was going to say,
hurricanes.
There's been no talk about hurricanes, but if there's a big hurricane season, this could change absolutely everything. So you want to be a bit careful. And this is the classic widowmaker, right? This is actually, I think the actual RBOB versus heating oil is called the widowmaker, if I'm not mistaken. So yeah, that would be an interesting one going into hurricane to watch out for.
We're anyway, I think, already seeing a 20%, like a really small percent formation around Florida. So it is starting already. So it'll be interesting to keep an eye out further into July to have hurricane season on watch.
Send the research team out there for a trip. Okay, so now let's move to looking forward. This is the crystal ball. Okay, let's get through this quite quickly. So yeah, I mean, all the things we've been talking about, Brent futures, the outright price, technical basis, the momentum, all looks bullish.
Yes.
Are we bullish?
I am cautiously bullish. I do think we're going to go up, but I see.
You guys always say this. You're like, yeah, it might go up, but also
it will go up. Definitely will go up.
Classic research. You have to say up or down, right?
Up until 69.70ish is my maximum, and then it'll go up.
All right, cool.
Yeah,
Harry.
Definitely bullish spreads. I think based on what you've been saying, I mean, flat price, it's tough. I mean, on a purely momentum basis, I think bullish at the moment.
Yeah, I'm going to go back to what we were saying earlier, which is we're due a headline that brings prices back down.
Yeah.
You've got the OPEC games on the bull side, and you've got the US games on the bear side, and they've been quiet for a while. They've been distracted, right? The Trump administration. But you would think now inflation is reeling its head again with the spending. He's going to need to keep prices low on oil, and that's his big indication for inflation. So I think he's going to come in and attack it again.
And if you're right, and if prices go higher, it just increases that pressure more for them to do that. So
I reckon it goes 67, 64, 59. That's up 3 days.
Yeah.
It comes back down again. I'm joking. All right, what about time spreads? Brent time spreads, I think there I would agree with you, right? The momentum's pretty unstoppable.
Yeah.
The margin's still strong. The margin's still got a way to go, even though they are compressing. So
yeah, I think I'd be bullish the Brent time spreads.
And WTI, I guess, utilization rates being higher. Yeah.
On a technical basis, just look at my chart here. I think I am definitely bullish, but I want to caveat that. So the bottom panel over there is the RSI, which has declined despite the increase in price that we've seen. So that could maybe flag declining, some form of declining momentum at these levels. But I think I'm still bullish. I'm choosing to ignore that and concentrate on the fact that we are seeing shorter date range moving averages. For example, the 30-day moving average rise above the 100-day and 200-day moving average. I think that's really significant. So I'm going to concentrate on that in the short term.
So you're essentially saying that CTAs spread and flat price, I guess, that buy momentum, there's just too much to unwind. So you basically do believe that they could trigger past this, because remember, we've had this 67 like top for a while. And do you remember we were saying like months back that it could even go to 75 if you bring back all the CTA buying? You're basically believing in that story.
I mean, for spreads, I do think the CTAs would see that and buy, but even with
But they could catch a bid off the back of flat price rally.
I think even just, for sure. But I think even just as a momentum story, just like a way to see where momentum's headed, I think the fact that the 30-day moving average is going above all these longer dated moving averages at a time where we've seen Brent sell off so much just past 2 months, I think it's really significant. So I think I'm going to stick with the bullish spread story on the back of
nice
that.
one. Okay, and then we've got the two cracks, right? Gasoline and distillate versus Brent. We've been bearish distillate for a while. I mean, I still just don't see the story, but I think it's an indication of, maybe you could say now, like the true indication of whether we're oversupplied or not. And like you said, if fuel oil does dump, we had this debate yesterday a little bit, like if fuel oil cracks dump because there's a lot more supply, that would mean they ran more heavier crudes, which means more distillate should come on as well, which means distillate should also weaken. But on the flip side, the more fuel oil weakens versus Brent, the more chance that gas oil versus Brent can stay higher.
Yeah.
Just on a give and take basis to keep the margins stable. So it's a trickier one, but I think you might as well, might as well maintain longer term view, which is bearish, but
Same.
I don't know, technical basis.
I'm bearish on a technical basis. So I will flag that momentum indicator. So if you look at my panel here, the histogram on the bottom is still flagging bullish, but if you look at that longer term trend line that we've been following, we're at the top of that, and I'm going to follow that. I think, considering the fact that we saw that really, like we've basically seen a long shadow candle yesterday at the top of that trend line, and now we're going down. I think I'm going to believe in the trend line story rather than what the MACD is saying.
Yeah, fair.
And I'm going to go bearish.
Cool. So we're all bearish.
It does look like, and then it's going to start narrow in a range and possibly break aggressively down.
Yeah.
I see what you're saying.
I think that's going to happen.
And then gasoline, this is the harder one because now we've had a sell-off.
Yeah.
I'd be a bit wary off the back of the, maybe complacent sentiment,
Yeah. I was going to say, I think just it's still summer. There's still, like you say, you can have refinery outages. You've had a move down. Hurricanes doesn't feel like the market is like maxed out at all.
And it can take all this momentum buying. There's all that momentum buying in the wings that could come in. There's all this speculative buying in the wings that could come. So there's a lot of reasons why you would be a bit brave to be short in gasoline right now.
Yeah. And I think, in line with thinking that, I think gas oil can come off, and I think then, like the argument you made for fuel oil with gas oil, I think gasoline can stay strong if gas oil comes off on a crack base.
naphtha weakens
and
as well.
I think gasoline can stay high.
So we were bullish to gasoline versus naphtha. We put that trade idea out there a few weeks back. That probably holds true still, right?
Yeah, I would say so. I mean, they just haven't really moved a whole lot, but I would still believe in that trade.
It's a safe way to be bullish gasoline right now.
I think I'd rather have that trade on than the outright gasoline crack, but given that we do have a gun to our heads, I think I'd be bullish the EBOB crack this week.
Metaphorical and literal, maybe.
Yeah.
But the other thing I wanted to say on that was what would be really cool, which I think will come in time, hopefully if we've got anything to do with it, is more options on these contracts. So right now, the volatility is clearly low, just from a standard deviation perspective on the crack. So if you were bearish, buying puts would be decent, because if you do get a huge spike, you're at least going to profit from the volatility. And I think that's the best trade right now. You can put it on. There are people who provide liquidity on it. It's just not like an open liquid market, which will get there. But that seems like the best way to be bearish gasoline if you were bearish gasoline. But
that makes sense.
Are we bearish? So we're bullish then?
Well, I'm going to go bullish this week. Yeah.
All right.
Yeah.
I'm going to go bearish, actually, just for the short term. I think we could converge to these longer term moving averages and then go up. I'm still longer term bullish gasoline, just like considering hurricane season and everything.
Yeah.
But for this week, I'm gonna go bearish.
Okay, we're going to get you demo account
Yeah.
Yes.
on Onyx Markets,
Yeah.
and we're going to do this live, and then we're going to see if you can finesse the market as well as you suggest. All right, thanks guys. We will leave it there. Thanks very much as always. Just a quick reminder, we will be moving this podcast and actually even more granular deep dive research podcasts and maybe more into Flux. So it'll start with flux.live so we can get you guys on the website. but it will be pushing more and more towards the Flux platform. Flux platform is very cost effective. Get long free trials to begin with now. You get it free if you sign up with Onyx Markets, and it's only $400 a month if you just want to buy Flux outright. It's very cost effective, the best fair value data in the world in oil, and there's going to be a lot of media content and research on there as well. So please check that out and get ahead of the curve, because as I say, we will be moving it there. But thanks again. Please like and subscribe, share to anyone who might be interested, and see you again next week.